I am Jeremiah Ajuda Dusu, the author of JAD's Business and Financial Accounting. Welcome to class again today. Okay, so let's not waste time. Let's move on. Of course, we are on the group profit and loss account. Okay, so we're taking another aspect now. Okay, so we're still on this. So today we're looking at profit on intragroup transfer or sale of what assets and excess depreciation on intragroup transfer of what assets. Now by asset here, we're basically looking at of course you can see non-current asset, right? Of course we refer to it as a fixed asset. Okay, so what we're actually seeing here is that there is a sale of asset, just like when you have sale of inventories within the group. You can have sale of assets, let's say a machinery. Okay, you can have a machinery transferred from the holding company to the subsidiary, or from the subsidiary to the holding company. Okay, so what we're saying is that there is a sale of an asset within the group. Okay, so let's say the holding company, for instance, okay, is selling a machinery, okay, or let's say a tool to the subsidiary. Okay, now that is what we call intragroup transfer or sale of assets. Okay, but remember that the holding company let's say bought an asset, let's say bought it for 2,000. Okay, and then let's say after depreciating for some period, let's say depreciation or accumulated depreciation on this asset. This is the holding company that bought an asset for this. Then after depreciating for some period, let's say for what? Let's say the asset has been depreciated for what? 400 naira. Okay, let's say that is because we have depreciation at 10%. So 10% of 2,000 is what? That's 200. So let's say that, for some years, your holding company has depreciated the asset for what? 400 naira. So that means every year is 200. So the carrying amount, or what you call the net book value of this asset is, of course, that will be 2,000 minus, that's what? 1,600 naira, right? So let's assume that as at when this asset was 1,600 naira, the holding company sold it to the subsidiary for 1,800 naira. The holding company bought an asset for 2,000, used it for a while, depreciated, okay, for 2 years, of course, 10% per annum. Now, as at when it is 1,600, he sold it to the seller for what, 1,800. You would agree with me that as at the time of this asset being transferred from the holding company to the subsidiary, it is now 1,600. So this guy here, okay, can you see? This guy here is now 1,800. So 1,800 minus 1,600 is how much now? 200 naira profit to the holding company. Okay? It's 200 naira, but profit to what? To the holding company. Okay? So now, let's say at this net book value of 1,600, it was sold for 2,100. So what will be the profit? It will still be 2,001 minus what? 1,600. Okay? As I went ahead this one, net book value of 1,600. It was sold to subsidiary for 2,100. So what will be the profit to the holding company? It will be 2,001 minus what? 1,600. And that's how much? 500. So it will be 500 naira profit to what? The holding company. You see now? So let's maintain this. Now, remember that because of the fact that the holding company had sold when the asset was 1,600 to the subsidiary for 2,100, the holding company had made a profit of what? 500. So, from the holding company's perspective, at separate entity level, the holding company will record this profit on what? Disposal as an income. So let's say we have the holding company here. Then we have the what? Subsidiary. Then we have CP and what? M. Of course, that's profit on disposal. That would be like other income. So we have other income. The holding company has made what? A profit of 500. So we have other income 500. Okay? The holding company has made 500 on this what? Disposal of this asset. Okay? Good. Now, that is at separate entity level. But when you want to consolidate, of course, it would have been 500 plus this to give you 500. Okay? That's assuming that subsidiary does not have any other income. Okay? This one would have been. But remember, at consolidation, we're trying to bring the income statement of the holding company and subsidiary to be what? One. So at separate entity level, this can stand. But at group level, now I want to make them one. It will be this of the holding company plus that of the subsidiary to be what? This, abi? But the thing now is, are you going to make a profit on yourself? Because the first thing is you cannot even sell to yourself. So if at separate entity level the asset has left the holding company to the subsidiary, of course it will be subsidiary. But now that they are becoming one, it's as if the asset has not gone anywhere. So that means that what? The profit that the holding company had made on these sales cannot stand because you cannot make a profit on yourself. If you're separate, if you're reporting separately, that's fine. But now you are consolidating, they're trying to make it one. That transaction cannot stand. You can't sell to yourself and you can't make profit on yourself. So that means that what? this 500 naira cannot what stand. So what will happen? We'll have to adjust for it, right? It means that this will have to go out. So that at group level, that profit will not stand. So at group level, we're technically taking that asset back to the cost. Okay? That's what the holding company purchased it. So it can no longer, the cost to the subsidiary can no longer stand. Remember that the holding company sold it for 2,100. To the subsidiary, this is the cost. To the holding company, it's what? A selling price. That's why they made a profit. Or what we call disposal value, right? That's how you make a profit. But at consolidation level, you cannot sell to yourself. You can't make profit on yourself. So that profit cannot stand. That's the essence of the what? Of the adjustment. We're trying to what? Eliminate that profit that, at separate level can stand, but at group level, you cannot stand. Because you can't make profit on yourself. That is it on profit on intragroup transfers of assets. But now, what is excess depreciation? Now remember that to the holding company, they bought the asset for 2,000, and they've been applying 10% every year. Right? They've been applying 10% every year, so it's 200 naira per year. But by the time it goes to the subsidiary, it's now 2,100. So 10% of 2,100, 0,000 is what? 210 per year. So of course, this is depreciation, and depreciation is an expense. So it would have been expenses, for instance, okay? Subsidiary would have what? Entered 210 as an expense. Okay? Do you understand? So this is an expense to the subsidiary. So at group level, it would have been 210 like this, right? Good. But now we are saying that this 210, that is depreciation on it, is at the perspective of the subsidiary at separate entity level. But because now we are saying that we can't set to ourselves at group level, so it's as if that transaction cannot stand. So we have already eliminated the what? Income on that transfer of assets. Because at group level, we cannot sell to ourselves. So we're trying to take the asset back to its what? Original cost, which is from the perspective of the what? The holding company that first bought it. So by so doing, we have eliminated what? The profit. This is what we have done. But now, if it is going back to this, that means depreciation would have been what? 200. But now, the subsidiary has used what? 210, because the cost to subsidiary is now 2,100. So 10% of this is what? 210. But since we have eliminated the profit, the depreciation has to go back to what? 200 naira. Now remember, subsidiary has used what? 210. But we have eliminated the profit and taken it back to that of what? The holding company. So it should have been what? 200, not 210. So now there's an excess for depreciation. Okay? There's an excess for depreciation. So what do? We have to eliminate what? The excess depreciation. We have to eliminate the excess for depreciation. So what do? The excess depreciation is what? It's 10 naira, because the subsidiary has used what? 210. But since you have eliminated the profit, that has to go back to 2,000, which is 200. So we have to eliminate 10 naira from this expense so that the 200 can stand. So for adjustment, this will be what? 10 naira. So that means that depreciation here will now be what? 200. Do you understand? So what we've just done here is to ensure that, okay, where there's a transfer of asset within the group, the profit element is what? Eliminated, okay, at group level. And then we also compare the depreciation. Since we have eliminated the profit, that means we're taking it back to the original cost. And then we compare the period that ought to have been done at the original cost and the period that was done with the new cost. So the difference has to be what? Adjusted for. Okay? So this is a very straightforward explanation. Okay, so take your time, go through. If you have questions, you can reach me on the numbers displayed. I'll get to reply with the right answers. So let's take, a straightforward question so you understand what we're talking about here. Okay, let's quickly take this question so we understand what we're talking about. It's a very straightforward one. So what do we have here? We have the following represents the income of Kings PLC and Queens PLC as an affairs 2018. So we have turnover, cost of sales, gross profit, total expenses. We have operating profit, other income, profit before tax, taxation, profit after tax, proposed dividend, retained profit for the year, profit carried forward. So information says Kings PLC acquired 5% shares in Queens PLC on 2016 when its profit was what? 800,000 credit balance. Goods worth 1 million with a cost of 800,000 sold to Queens PLC by Kings PLC were yet to be sold by Queens PLC at the date of reporting. As at 1st January 2018, Kings PLC sold an equipment of 900,000 naira with a carrying amount of 720,000 to Kings PLC for 1 million. The depreciation rate on the equipment is 20%. Queens already charged depreciation for the year. You are required to prepare the consolidation schedule and consider income statement for the year ended 2018. So this is a very straightforward one. So let's quickly. So we'll go down. Let's go. We have the consolidation schedule. Okay, so we have Kings, Queens, we have adjustment, and we have C, P, and L. Okay. Good. So let's go. We have our turnover. What's the turnover here? 2017. So we have cost of sales. What's the cost of sales there? 11,200, 10,650. So this is our gross profit. What's the gross profit? 8,800, 6,350. 6,350. And we have total expenses there. What's total expense there? 3,650. What do we have? 2,080. So this is operating profit. What's the operating profit? 5150. What do we have? 4270. So we have other income. What's other income there? 3500. Then we have 2650. What do we have? 8650. 6920. So this is your profit before tax. So what's the tax there? $2,768. And 2214. What do we have? 5882. And 4706. This is your profit after tax. Okay, so what's the first adjustment there? King's PLC acquired 5% coins on this 2016 when profit was 800 credit balance. Okay, now goods worth 1 million with a cost of 800 sold to Queen's PLC were yet to be sold by. That's unrealized. Okay, profit on what? Intragroup sale and purchases. Okay, so what do? We have to adjust, right? So this guy here, we are adjusting 1000. We've seen the question has already given us the sales and the cost of sales, right? Which is like the purchases. So we have 800 here. Okay. So obviously this will be 200. So what do we have? We have 20,000 plus 17,000 minus 1,000. This is 36,000. So what do we have now? 11,200 plus 10,650 minus 800. That's 21,060. So what do we have? 3,600 minus 21,060. 14,940. We'll check it this way. What do we have? 8,800 plus 6,350. Excuse me. 8,800 plus 6,350 minus 200. What do we have there? hold on, 11,200 plus 10,650 minus 800. Okay, this is 21,050. So this will be 5 here. Okay, so what we've done here is to adjust for what? The intragroup sales and purchases. You know, there was sales made by the holding company to the subsidiary to the tune of 1 million, but the cost of that product is what? 800. So the profit is 200. So we've adjusted for it like this. Okay? So the next one, they said, as at first January 2018, King's plc sold an equipment of 900. Equipment of 900. Okay. Then carrying amount, which is like the net book value, was what? 720. Okay. Then what else? They say it was sold to Queens for 1 million. So this is the holding company. Now Queens bought it for 1 million. So what's the profit on this? So profit on transfer of asset now is 1 million minus 720. So what do you have? 280. Now remember that the holding company purchased it for 900, but when they are selling it, the net book value was 720, or the current was 720. So they sold it to what? To the subsidiary for 1 million. So there's a profit on this what? Asset, which the holding company must have what? Reported at separate entity level. So this 280 has been reported as a profit on disposal. Okay, which of course will be where under income, right? To be under what? Income. So this profit cannot stand at group level. You can't stand at group level because you can't make profit on yourself. You can't even sell to yourself. So we're going to have to take the cost of the equipment back to what? Its original cost. So now we have to adjust for the profit element. Okay? So it's an income. So it must have been reported here. So now we have to adjust for it, right? So this 280 has to come out. So this other income here. So this 280 will be adjusted for here. Now they say there's a depreciation of 20%. Now Queens already charged depreciation what for the year. So Queens depreciation would have been 20 over 100 times 1 million. Okay, which of course will be 0, 0, 0, 0. Okay, so what do you have there? 0.2 times 1.8. Excuse me. 0.2 times 1 million. That would have been 200,000, right? That's Queen's depreciation. Now they say they have already charged it. So Queen have already charged depreciation, which would have been part of this expense. Okay. Now, but we have eliminated the what? The intragroup transfer. So that means we are technically taking the cost of the asset back to 900, which is going to be 20% of what? 900. So holding company will be 20 over 100 times 900,000. So what's the holding company? 0.2 times 900. 180. Okay, so since we have eliminated the profit element, and then we're taking it back to the original cost. The real ought to have been 180, not 200. So the subsidiary would have depreciated, by 200. But because we are at group level, we say that transfer or sales cannot stand. So we're going to have to take it back to the that we eliminated the 280 profit. And now the depreciation, instead of it to be 200, will have to be 180. So, but Queens have already charged depreciation for 200 based on the question. So you want to have 180. So what's the difference between 200 minus 180? I think that is 20,000. So we have to adjust for 20,000 here. So we say 20. We have to adjust it for here. So negative 20, positive, negative 200, positive 20. That will give us negative 180. Okay. So if this goes this way, we have 3650 plus 2080 minus 20. So this will be 5710. Take this out. 14950. We have 9240. So let's check it this way. $5150 plus 4270 minus 180, 9240. Okay, so other income will be 35 plus this 3500 plus 2650 minus 280. So this will be 5870. Okay. So this negative 180, negative 280. That's negative 460. Okay. So this is 9240 plus 5870. This is 15110. Test it this way. We have 8650, okay, plus 6920 minus 460. That's it. So taxation, of course, you have this 27680, 2768 plus 2214. That's 4982. Okay. This will be 10128. So this will be negative 460. 5882 plus 4706, okay, minus 460, 10128. Okay, so what we've done here is to prepare the schedule, taking into consideration the adjustments on, intragroup sales and purchases and intragroup transfer of assets. So here we are. Okay, so with this now, let's prepare the consolidated profit and loss. Okay, so let's go. So we have Kings and its subsidiary. So we have consolidated profit and loss for the year ended 31st December 2018. So we have turnover as 36. Cost of sales 21,050 as 14,950. Gross profit. Total expense is 5,710. What do you have? 9,240. So this is the operating profit. And we have other income. What's the other income? 5,870. So what do you have? 15,110. So this is your profit before tax. And what's the taxation? According to the question, we have 4,982. What do we have? 10,128. This is the profit after tax. So let's go. We have holding company, which is Kings, to be what? 85%. Minority interest to be, what's that now? 15%. Okay, so of course you have the profit after tax here. Okay, so that will be this guy times 4706. Okay, so that will be what? .15 times 4706. We have 705.9. So we say less minority interest. That will be 705.9. So what do we have? We have 9422.1. So this guy here is the profit attributable to what? To the group. So now we can pay dividend because say proposed dividend. So what's dividend according to the question? For the holding company, remember 2647. 2647. So what do we have? Two, 6775. 6775.1. So we say this is what? Retained profit for the year. So what do we do now? Retained profit brought forward. Let's show that here. So let's go. Okay, so we have King. What's the profit brought forward? 3150. So twins will be what? 1860 minus the pre, that's 800. 1860 minus 800. So what do you have? We have 1060. That will be times 0.85. That will be 901. So what do we have? 4051. So we have 4051. So we take this here, 6775.1. That's 10.826.1. So this is what? Retained profit carried forward. Okay. So in this class, what we've just done here is to prepare the consolidated or profit and loss, taking into consideration adjustments around intragroup sales of inventory and intergroup sale of what? Assets. Okay. So you can take your time, go through it. If you have questions, you can read the numbers displayed or drop comment there in the section of in the comment section. Basically, I'm going to reply with the right answers. Okay. See you next class. Thank you. Bye bye.